Welcome to Macro Matters, a podcast where global experts offer clear-eyed analysis on global economic policy. I'm your host, Emily Slater, Executive Director of the Bretton Committee. Each episode, I sit down with BWC's diverse network of members, from global policymakers to private sector leaders, to discuss timely topics in economics, geopolitics, and finance. In a media landscape full of noise, these conversations offer clarity. We go beyond the headlines to explore not just what's happening in the global economy, but why it's happening, what it means, and what might come next. Welcome, everyone. We are here today at the BIS Innovation Summit in Basel, Switzerland, and I am very excited to have on a very esteemed guest here with us today who, of course, knows Basel well and knows the BIS well, and we are going to get into a lot of issues around future of central banking, future of financial stability, monetary policy, all issues that are relevant to the BIS and to Stefan's background. So quickly to introduce my guest, Stefan Ingves, former governor of Sveriges Riksbank, former vice chair of the BIS, former chairman of the Basel Banking Committee on Supervision, and a BWC member, and has been engaged in a lot of BWC's work on central banking and cross-border payments. So, Stefan, we are at the Innovation Summit here. We've had a couple of days now of sessions and hearing a lot of discussion on really new technologies and innovation. That's really the theme of the summit is kind of sort of future-proofing central banks. So we've heard all about the innovation hubs projects in regards to technology. We've heard a lot about AI. We're talking about digital assets in terms of tokenization, stablecoins. Heard about quantum computing. And so really what this summit has been about is how the central banks are thinking about all of these technologies and what that might mean for central banks going forward, how they're going to kind of deal with these as they're implemented in the market. So, since we're here, we're finishing up the Innovation Summit. I just want to start by asking you sort of, what are your key takeaways from these last couple of days, and sort of what do you think about what the biggest challenges are for central banks going forward?
Many central banks have been around for a long time, and intellectually we come from an environment where everything was on paper. And now it's absolutely clear that going forward we are moving into an environment where nothing will be on paper.
Yeah.
Everything will be digital in one form or the other. At the same time, when it comes to money is a convention. Money is about what we have in our heads. And given that the world is shifting right now, that makes it absolutely necessary in the central banking world to think about money, but think about money in a setting where new technologies are emerging and evolving. And I think that the past few days is kind of about a consensus that this happens. And that, of course, raises the question, now what? What do we do? And many of the panels and the issues are being discussed here is essentially a long to-do list about what is going on, with the sense that this is not going to go away.
Yeah.
Like it or not, we're going to have to deal with it as best as we can.
Yeah. Some technologies may be more successful than others, but technological innovation and disruption is inevitable. And I think I've been encouraged by the fact that the BIS and the Innovation Hub here are really thinking about this. I mean, they're really trying to be forward-looking. I mean, we always hear that sort of the markets in the private sector move so quickly and the public sector is always, playing catch-up. And I think that's true, but I've been encouraged by some of the discussion at this summit and some of what we're hearing that, that the central banks are really trying to stay on top of this, on top of these technologies, and really think about, how to manage them and manage both the risks and the opportunities.
No, that is absolutely true, and I mean here we have participants both from the central banking community and the private sector,
Yeah, that's
and
right.
most of them on the IT side pretty much I think have more or less the same background.
Yeah.
So it's important actually for all these people to meet and talk to each other and sort of think hard about what's next, what is doable, what can technology do.
Yeah.
How can we use these new technologies
Yeah.
in order to make something which people really, something which is of benefit to the general public?
Yeah. So sticking with some of the technologies, I mean, one of the things at BWC that we've been, I think, pretty excited about on the technological front is some of the digital assets and some of the innovation that's been taking place there. And you've done work with Bill Dudley on our cross-border payments paper, where, we've really kind of looked at the sort of G20 roadmap and objectives for how to make cross-border payments more, efficient, quicker, more frictionless. And there's a couple BIS projects here that we that are kind of in focus that we've been talking about: Project Nexus, Project Agora. I think at BWC we really see the cross-border payments as one of the best use cases of some of the innovation. So tell me a little bit about kind of where we stand on cross-border payments, where we stand on this G20 roadmap, what's getting done, what's not getting done. What are your thoughts?
I would say with hindsight, and I've been in this business for a long time, people have been talking about cross-border payments for as long as I can remember.
Yeah.
And that's not really a good record, because
Yeah.
some of these things actually can be fixed and probably could have been fixed some time ago. But now we are at a point where many things are going on at the same time. And I do think that most people agree that we're not really today talking about technological constraints. Because you can do many things today, and given that I can talk from Basel to somebody in New Zealand in real time, then many individuals find it strange that I can do that, but the money doesn't move.
Yeah.
Or it moves slowly, or it costs a lot of money.
Yeah.
So and that creates tension. That really creates tension.
Yeah.
And there is a consensus today among people who deal with these things that yes, these things are doable, but then you need to come to agreements on how to do them.
Sure.
And that's where it gets complicated.
Yeah.
That's where it's hard, because you have to move from talking about things to actually getting them done. And then you mentioned Project Nexus as one example, and that sort of is one way of showing that you can actually do this. But to really make it happen, then you have to have a governance structure, and you have to have somebody running these systems, and you have to come to agreements on how to do it, and that takes time.
And that's where it's been getting stuck.
Yeah.
And takes political will.
Yes.
And that's probably getting a little more difficult to reach consensus as the world is getting a little bit more fractured, I think. So what do you think are some of the prospects for moving forward?
The world, as you say, is getting more fractured, but on the other hand, no one, as far as I recall, has said that we're going to start imposing capital controls or something like that. So money can still move around the globe, and that means that there is a need to talk about these things. But at the same time, when you talk about IT systems and when you talk about how to implement things, it's easy at the intellectual level to come up with the idea that we need a global system.
Yeah.
But it's completely different to actually produce a global system. So
Yeah.
a kind of a gradual approach where you try to prove your case, let's say in a regional setting,
Yeah. Yeah.
I think is more,
Right.
that is more likely to happen.
Yeah.
Because the distance is just too far if you talk something global from day one, because it just won't happen. So if we can do this step by step. If we have a few countries that can kind of prove that it is doable and that it actually happens, and then hopefully you take it from there, and eventually more and more countries join.
Yeah. So kind of a building blocks
Yeah.
approach, regional building blocks approach. And of course, one of the sort of takeaways in our work on cross-border payments was, even in that regional building blocks approach, you kind of need all countries to have a fast payments system to be able to then integrate, right, integrate them cross-border. And of course, the U.S. as the global reserve currency and one of the biggest money movers, it doesn't have one. It doesn't have really any incentive to move towards a fast payment system.
No, that is correct. But as I said yesterday on the panel, keep in mind that the IMF has 191 member countries. And that means that if one is different, a big one, a good number of the other ones are going to move anyway, one way or the other. So that's one set of issues. The other set of issues is a bit similar to stock exchanges. If you go, let's say, 20, 30 years back, all stock exchanges were national and local in the old days, and you had trading floors. So it was very sort of physical. Today you can buy a stock exchange off shelf. And in the future, I'm pretty sure that you can buy a payment system off shelf as well. And that means that we're moving in that direction. And that also creates a need for many countries, I think, to cooperate, because particularly in smaller economies, it doesn't really make sense to do everything yourself from scratch. So you're better off actually doing this, creating a group of countries to do it.
Yeah. Well, let's stick a little bit with some innovations, but I want to kind of turn more to the financial stability side of things. There's been a lot of conversation right now about stablecoins, CBDCs, kind of the ecosystem around that. There's, certainly questions about sort of monetary sovereignty, especially here in Europe. I think a lot of reaction to the recent legislation passed by the U.S. to put some regulatory guardrails around stablecoin usage and implementation. So I think one is, I guess from a financial stability perspective, do you think some of these stablecoin regulatory frameworks that have emerged, the U.S., there's some in Hong Kong, there's MiCA in Europe, do you think this is a step in the right direction? Are you concerned about financial stability risks from some of these new digital assets and technologies?
It's better to have some kind of framework compared to having nothing at all.
Agreed.
And if you have too many flowers out there blossoming, then eventually some accidents are bound to happen somewhere. So it's a good thing that this sort of conversation is going on. Time will tell if the legal frameworks will become more similar over time or not. I just don't know. Too early to tell. But this is really a combination of three things. You need to understand something about money, what money is, and that's kind of a specialty of central bankers. It kind of goes with what you do.
It goes with the territory.
It goes with the territory. So that you need to understand. Second point is that you also need to understand IT, because the IT technology defines what you can do with money today and how you can move money around. But then you have the third part, and that's the legal framework, because without a legal framework, you basically have nothing.
Yeah.
And it's pretty tough to combine those three specialties into something which is really, really, really good. And we're still in the early stages of that.
Yeah. Yeah, and I think that's, again, something that at the Innovation Summit we've really seen, that they are combining all of those three specialties here, and we're having discussions with those three kind of stakeholders and trying to really, they're fostering conversation here to really co-create the optimal kind of frameworks.
And this is tough because IT people prefer to talk to IT people. Macroeconomists prefer to talk to...
They don't speak the same language, right?
Macroeconomists prefer to talk to macroeconomists, and here you'll have to get all of them into the same room.
Yeah.
And they need to get a level of common understanding when it comes to what they want to achieve.
Yeah, that's right. They certainly don't speak the same language. So kind of getting everybody on the same page is, half the battle, right? To even be able to move forward. Okay, so maybe on some of the stablecoin stuff, a little too early to tell if there's really financial stability risk, right? Anything systemic here. But we're going down this path, and we're going to start seeing how it goes. But are you concerned?
Two things are obvious when it comes to this. One is, of course, IT security as such.
Yeah.
because you don't want, technically speaking, to have the money disappear or somebody else kind of messing you up with those systems. The other part, which is definitely not going to go away, is KYC, know your customer, money laundering, tax evasion, and all the rest of it. And it would be very unfortunate, I think, actually at the global level, if we were to end up in a situation where you have kind of formal systems, and central bankers deal with formal systems, and then you have a bunch of completely informal systems where there aren't any rules at all. So this will remain an issue for probably many years to come.
Yeah, and we'll need to see some convergence.
Yes.
Right? Yeah. Which of course is what the BIS and FSB were designed to do, right? To have discussions about how that convergence should move forward globally, which we'll get into a little bit more of that in a few minutes. But tell me a little bit, I'm just so intrigued by kind of the global reaction to the U.S., to the Genius Act and the stablecoin regulation, because I feel like everyone's been quite surprised that the U.S. is, finally, come out with some regulatory guardrails, because it had really been stuck for several years. But it was clear that the U.S. was always going to go the stablecoin route and not the CBDC route. I mean, that was kind of clear. So now there's this big reaction, and I think Europe and China and other countries that are, kind of trying to figure out how do they move forward with, their digital euros, right? Digital money. Can there be worlds in which CBDCs and stablecoins exist? And sort of what are the monetary sovereignty issues that you see around this whole debate?
Well, first of all, when it comes to monetary sovereignty, it's very important that you have stable money. Nowadays, we explain that in terms of an inflation target.
Yep.
So if inflation goes to 1,000%, there's nothing that can save you. Because essentially, money is a product that produces a service to the general public. And if it's of good quality, people will use it. And if it's of bad quality, they will use somebody else's money. Now, in addition to the whole business about stable money, inflation, and those things, which is what we very often talk about, I would like to introduce the term transactional efficiency, which is essentially saying that it has to be easy and cheap to use your own money. And if it is not, then you will start using somebody else's money. And in this day and age, when you can move stuff to the cloud and it's difficult to say where money is located, then it becomes a more kind of competitive environment than in the past, because the general public will have more choices. And that means that you have to think through domestically, are we up to speed when it comes to this? What is it that we, the central bank as an institution, are supplying? Is it good? Is it not so good? Is it likely that people will move elsewhere? But it's also a value judgment to what extent you want to have a central bank digital currency or not.
Right.
And that's a value judgment. Economists cannot sort of take care of that issue. And because at the end of the day, it's a political decision that is required. Because do you want it to be possible for your citizens to hold central bank money or not?
Yeah.
That's really the crux of the matter. And here, different countries can come down in different...
They can take different paths, policy pathways.
Take different paths.
Yeah.
And most likely, we will see many different paths. But I think it's also important to, again, back to the 191 number. We tend to forget that in a good number of poor countries, the central bank is one of the better, or if not the best functioning institutions. And that means that in those environments, with a fairly high likelihood, if you have your own currency, people will have a preference for holding a central bank digital currency compared to holding private money, which is not at all the case in many other countries. So we will see a variety.
Okay, turning a little bit away from some of the more innovation issues, I want to get into some of your core expertise, really around financial stability issues and what you worked on in this building for so many years, Stefan, right? With the Basel III standards post global financial crisis. I mean, you were really, the one spearheading driving that whole agenda and those negotiations to get the world to come up with a safer, more sound system post-crisis, which I think everyone has agreed has, we've weathered the COVID shock. I mean, the system is stronger, it's more capitalized, it's better, it's sounder, it's safer. So first, kudos to you on that. But I want to kind of ask a little bit about, we're starting to, hear some conversations in the U.S. about what the sort of U.S. agenda is going to be on the regulatory front. We don't know, but, kind of the Basel Endgame stuff in the U.S., there was pretty strong pushback against some of those last final kind of standards being implemented. So just want to get your take a little bit on where do you see the global regulatory agenda going from here? Do you think we're heading towards a deregulatory race to the bottom if the US makes some drastic moves? Do you think we're going to see divergence? Kind of just what's your take?
I mean, we have always had elements of divergence, so we have never really had kind of, in some sense, a uniform global system. But here we're talking about, and the Basel Committee came from a conversation about globally active banks, which means that smaller banks have always done many different things in different parts of the world. But as long as you move money around freely, and that's going to stay, I think.
Yeah.
Then you're gonna have a push towards uniformity in one way or the other. But then periodically you will have attempts to diverge. And here there is an element of, I would say, cyclicality to the whole thing. And here I think it's unfortunate, if I'm talking about it from a Basel III perspective, that the whole thing came out of the global financial crisis. Many different things had to be fixed, taken care of. It took many years to get to Basel III, and then it takes another more than 10 years to implement. And I think that some of these rules and regulations, at least in a European context, are being implemented around 2030 or 32 or something like that. And then, of course, those who are active in 2032, they are going to ask themselves, why was it that grandpa did this or that such a long time ago? And we always tend to think that this time is different and that we know better. So there is a sort of an element of cyclicality to this. And as long as the times are reasonably good, you will always find arguments that the supervisors are in some sense too strict. And if we can sort of pump up the system again by increasing leverage, everybody will be happy ever after. But if you read the Reinhard Rogoff book that goes back to medieval days, This Time is Different, we sort of make the same mistake over and over again when we sort of say, now we're going to fix this once and for all. But unfortunately, that's not really the way it happens. So we have to keep at it, just keep at it and be persistent. And as I said, with free capital flows, there is a pretty strong incentive to hold these things together. Maybe not 100%, but at least if you get to, let's say, 85 or 90, you should be happy.
Yeah, very close, as you said, and it takes so much political will, and that's really the hard part, and that's you lived that firsthand, right? I mean, are there parts of the sort of Basel III agenda, endgame, et cetera? Is there unfinished business that you would like to see done moving forward?
There is always unfinished business in the sense that keep in mind that all these rules and regulations, there are compromises, and many people have had strong views on this and that. And also, in order to get things done, sometimes you just basically have to say that we are done. And that usually means that some, let me call them imperfections, pop up and bubble up to the surface over time. So I would never really say that these things 100% are perfect and done. And in that sense, there is actually a bit of a similarity between these types of rules and tax systems, because you can have all sorts of views on tax systems, but they also tend to get complicated and they're gradually changed over time.
So looking at kind of the financial stability, landscape, systemic landscape, what are you most concerned about? Where do you see risk at the moment?
It's always the same issue. Where did leverage go? So you're kind of always on the lookout for leverage, and if this phenomenon, whatever it is, and if it's of a very large size, so that sort of people get carried away with it, then that runs the risk of actually becoming systemic, and that is dangerous. And then the money has to come from somewhere from the beginning, which usually is from the old banks.
Yeah.
And then you have to be careful so that you find those over-leveraged sectors early enough so that you don't end up with a situation where you say, oh my gosh, is this what this actually looks like? Because then you end up with this kind of ex-post conversations where you say, we should have seen it, or we should have understood. I think it was the Queen of England who asked the question, didn't you see? or something like that. So that's always the same issue. And then of course when people start talking about, let's say presently, simplification, saying that these rules and regulations are too complex. And yes, they are complex, but then one has to be careful so that simplification does not mean that capital charges go down.
Yeah.
And there's a sort of a constant pressure to sort of roll back in order to pump up the system in the short run.
Yeah.
Because the benefits in the short run are such that there is an incentive in the short run to do this. And then you have this constant trade-off between now and in the future. Now and in the future.
Yeah.
And given the way the human mind works, it's so easy to say, no, not now.
Yeah.
I'll deal with this problem later.
So on the simplification, I mean, do you think there's any areas of the Basel III or of the sort of international regulatory framework that should be revisited or that could be rethought?
Well, let me put it like this. The most complex part of these systems is actually the bank's own internal models. So the banks and the bankers themselves have actually been party to what has evolved over time. And that's one of the complexities we have when it comes to all of this. Yes, you can simplify. You can probably simplify in many different ways, but that means that the leverage ratio has to go up because the leverage ratio is simple and easy to understand. And usually the private sector is vehemently against that.
Yeah.
So you really, really have to be careful when it comes to what you're asking for and how you want to simplify. I do accept and understand this conversation about making it simpler for smaller banks, for example.
Yeah, yeah.
Because they just don't have the capacity to use the most complex systems. But then capital has to stay where it is and definitely not go down. And there is a trade-off here, because if you really want to run the financial sector with very little capital, then there are very few things you will be allowed to do, and that will be very complex. And the more capital you have, the more degrees of freedom you will have in terms of what you can allow banks and others to do. So you constantly have this trade-off, and people will probably discuss these things forever.
Yeah, yeah.
How to get the balance.
The balance right.
Right.
In the cycle that you were talking about, at that point in the cycle. One of the big conversations that we hear a lot about in terms of financial stability risks right now is actually that the risk is pooling outside of the regulatory perimeter, the banking regulatory perimeter, right, and non-banks and private credit. Kind of how do you see that? Are you concerned about that? I mean, should there be a conversation, about regulatory frameworks in this sort of, non-bank sector?
When it comes to private credit, I have a hard time seeing why you would end up massively with private credit, because we have had sort of commercial banks for hundreds of years, because they specialize in understanding what corporations are doing. So they sort of collect information and they gather this information and they pass judgment on what they know. And I find it difficult to understand, if you do a lot of private credit, that the individuals who actually do this type of private credit would come to the same level of understanding. So you can probably have private credit, but on a small scale. But I still do think that we will have banks for a long time to come. And I think there's one observation of mine that matters here, because I have during my years at the IMF worked in many countries where they were in deep economic trouble, and also in countries where more or less kind of the banking sector collapsed. But the banking sector always recreates itself sooner or later, because we need banks.
We need money, yeah.
Because
we need to loan in, yeah.
Because they provide services.
Yeah.
And also based on this sort of kind of dismal observation, there's a sort of something positive about it, in the sense that banking produces a service to the general public.
Yeah, much needed, yeah.
And banks are much needed, and they're not going to disappear.
All right, maybe moving a little bit towards monetary policy issues. We'll kind of wrap it up there. I think there's a lot of conversation right now, of course, about monetary policy, central bank independence. I mean, of course, in the U.S., we have a big Fed FOMC meeting coming up next week. A lot of pressure on the Fed right now, a lot of questions about its independence. I guess maybe first question is, we're expecting Fed rate cut next week. I think that Governor Powell kind of previewed that in his speech at Jackson Hole. In terms of what the U.S. trajectory looks like in terms of interest rate cuts, what implications will that have globally, do you think?
I really don't want to pass judgment on interest rates, because I've been in this business for so long, and it's not my job to behave like the old guys in the Muppet Show, sitting there yelling what to do. It's hard enough when you are in this business to do things on your own. So I'm pretty sure that those at the Fed are doing their utmost when it comes to coming up with a wise decision.
Yeah, and it's a really uncertain environment. I mean, they're really grappling with uncertainty, right? And there's no playbook for this, I think, right, in terms of the level of tariffs that we've seen and the impacts of that. So it's a tough job. But I'm just wondering, how do other central banks, when the Fed makes a decision, sort of how do other central banks think about that? Is there any sort of, look what they did, do we have pressure now to do the same thing? Or is it all really domestic conditions that kind of drive this?
With free capital flows, everything sort of in some sense hangs together.
Yep.
And particularly in small open economies with completely free capital flows.
Sure.
Basically, at the end of the day, you import the global real rate of interest. So that matters. But at the same time, I would say that all central banks, or almost all central banks, have a national mandate.
That's right, yeah.
So that is definitely what comes first. That's what comes first.
Yeah.
And your job is not to sort of follow somebody else, but at the same time, you need to understand that when others do things, it will affect you.
Right.
And that you have to sort of factor into the equation, and think about to what extent that matters to you, to your particular institution or not.
Yeah, and your mandate.
And your mandate. And it's easier if you're an inflation targeting central bank, and I come from that environment. And the opposite is the Danish neighbors, because they have had a fixed exchange rate vis-a-vis the euro for a long time. And then, of course, in that environment, you can't really argue about monetary policy. You import your monetary. You just have to. You just have to. But it's not that central bankers, in some sense, collectively get together and sort of decide to do this, that, and the other, because it's clearly understood that all central bankers have a national mandate.
Absolutely. Maybe just kind of sticking with sort of central banks. I mean, as I said, the Fed in particular in the U.S. has, there's been tons of headlines about it being under pressure. But, tell me a little bit about sort of why most central banks are independent. Not all, but most central banks around the world have this sort of independence model. Tell me why that's important in terms of monetary policy making.
I mean, I ended up working for many years in an institution that was established in 1668. And now independence is very often called inflation targeting. But the issue has stayed the same. And it's very basic because politicians and many understands that at the central bank, that's where the money is. And then you actually need to control how much money you supply to the system as a whole, because otherwise you end up with too much inflation. And this has been tried time and time again all over the world, where you have not succeeded and just failed when it comes to inflation. And of course, worst cases are hyperinflation.
Yeah.
And a good way of phrasing this is basically to say that this was said by a Federal Reserve governor in the early 50s. You have to have somebody who's willing to take away the punch bowl when the party really gets going. And again, it's really about constraint. It's a self-imposed constraint for the system as a whole, with the conclusion that on average, in the long run, that will produce a better outcome. And that is what really matters. But you always have this difficult trade-off here and now, and then the future. And how do you stay? What do you do institutionally, and what governance framework do you put in place in order to stay on the narrow path?
Yeah. I guess I would just be curious to hear too. I mean, obviously, you know, BWC is based in Washington. I mean, a ton of headlines right now about, you know, what the U.S. is doing. How do you, you know, non-U.S. citizen, how are you just sort of viewing, you know, what's going on in the U.S. landscape in terms of, you know, just central banking, in terms of financial stability? You know, how is the world kind of reacting to some of this?
Well, I can't speak on behalf of the world. I can only speak on behalf of myself. And of course, what's going on, speaking for myself, is that I never ever expected many of these things to happen.
Yeah.
And that, of course, leaves you sort of scratching your head. I don't have a lot of hair to scratch, but sort of wondering now what? Because talking about sort of the money part of it, everything has always been done sort of on the assumption for many, many years that this is it's a stable place.
Yeah. And you know, U.S. dollar as the reserve currency, you know, certainly big factor, and I think, you know, big for the rest of the world in terms of what they're watching now and how the U.S. is going to kind of approach the strength of the dollar and through its policy making. Maybe we'll just end on, you know, we're at the BIS Innovation Summit. We talked a little bit about a kind of global cooperation, coordination. So in this landscape where the U.S. is, you know, pulling back as a kind of global leader, I think fair to say, under this current administration. And, you know, it has some skepticism of international organizations, right? Like maybe like the BIS, like the IMF, like the World Bank, UN, et cetera. Kind of how do you see the future of, you know, central banking coordination, financial stability coordination and cooperation? I mean, we said it's sort of getting harder, we think, in this landscape. So, you know, do you think anything's going to continue to get done? Do you think it's going to get harder? Do you think there's political will to continue to move forward?
Hard to tell, but at the same time, it sort of goes with the name of the BIS, the Bank for International Settlements. And given in this day and age, and with the sort of IT developments that we've been talking about here for a couple of days, it's getting easier and easier to move money around the globe. And that pulls the whole thing in one direction. And then to just stop cooperating, it's not, I think, in a meaningful way of going about, because everybody over time will actually be better off by cooperating. And that's why actually the BIS has existed since 1930.
Yeah.
So there's got to be something in it, because otherwise this institution would have ceased to exist a long, long time ago. So these things tend to be kind of cyclical. And now we go through a period when this is sort of lively discussed, but at the same time, given the technological changes that are taking place, as I said, it's getting easier and easier to move money around, and that means that you still have to keep talking.
Money talks.
Yeah, you don't need to agree on everything, but still you need to keep talking.
Yeah.
Keep talking.
All right. Well, we have covered a lot of ground. I appreciate you taking the time to chat with us today, Stefan. Always great to get your views, and no one better to kind of talk through all things central banks, all things financial stability. So I appreciate you taking the time and appreciated hearing your insights.
Thank you.
Thank you.